Let's kick it off with the job cuts. 15% of your staff, you have about 18,000 employees. So this is several thousand, almost 3,000. Is this it, or is there more job cuts to come after this?
No, this is it. That 15% represents our plan on roles reduction through 2024. So it's 4 years, and it's a material amount contributing to the 700 million of cost savings. But it's roughly what we've executed over the past few years, and we'll do it steadily over time through natural attrition. We'll retrain our staff, so it won't be all at once. It will be steady, considered and deliberate.
Clifford, good morning to you. Steady, deliberate and considered. Which portions of the business are going to bear the biggest job losses? Will it be the retail branch network? And if so, what portion? Or on the corporate investment banking side? How does it split down?
It will be our cost savings, and consequently our role reductions will be across the business. We have quite a small branch network in the Netherlands, a little over 100 branches. So a lot of that branch reduction has happened, and we expect to bring that down steadily over time. So no figures there regarding branches. As you know, we announced that we would wind down our corporate bank outside Europe earlier this year, and that's a part of that 15%. We're also digitizing a lot of the processes within the bank, and that will have an effect on roles as well. But we'll be creating roles, as I indicated earlier, in respect of growth segments that we see in our business. So we will use technology to deliver convenient banking daily services, and increasingly we'll apply our people to helping our clients solve their financial problems.
Clifford, you guys have promised to come with a capital update, but to this morning you have the same targets for the dividend. Why is it unchanged?
No, we have given our capital framework, and we're announcing our payout ratio will be 50% of earnings. We've also indicated the level of capital that we're targeting, 13% Basel IV, and we'll consider buybacks when we're in excess of 15%. So we've given clarity around our capital framework when we're able to resume dividends. As you know, the ECB has a recommendation that banks in Europe don't pay dividends right now, and we'll clearly comply with that. But over time, as that's lifted and conditions improve, we want to give clarity on dividends and possible buybacks and our approach to that, and that's what we're doing today.
So, Clifford, on the timeframes, and I've been through this with a number of CEOs who give us the timeframes for that Basel IV target that you've just given, which is the contingency for the payout. What is your timeframe, and how optimistic are you that it's realistic?
Well, what we're doing today is we're actually adopting Basel IV, so it's the new capital framework, the new capital rules, as our primary metric. We think the time to do that is today and not wait for the rules to come in, because we want to be well prepared and to manage the bank on a glide path through Basel IV. So currently the expectation is 2023, but we're prepared for that now. Our capital position is already 15%. And by adopting this as our primary capital metric, we can give the bank and our investors comfort and stability about what they can expect. So we're well capitalized at this uncertain time. And when the ECB recommendation is lifted, we'll consider dividends and buybacks based on the framework I gave you earlier.
Do you think investors are just too demanding in their hope for shareholder payouts, given the economic crisis and the uphill battle a lot of banks, especially in Europe, face?
I think it's right that investors look to banks to provide dividends. I think that's why all investors own stocks, and banks, have been an income stock. But in times like these, uncertain economic times, I think it's right that banks such as ABN Amro really safeguard their financial strength, and that money remains within the bank. So I know investors get frustrated about the dividend ban, but the money is in the bank, and we stand ready to resume dividends when the ECB recommendation is lifted and when conditions are less uncertain. And so our bank, ABN Amro, is in good shape. you know, our capital position is around 15%, so it's around the level that we would consider buybacks at the right time. So we're pretty resilient in current times.
What scale of buybacks would the ambition be? And I want to get a sense, Clifford, is today's moves, are they defensive plays or offensive plays to bat away a takeover possibility?
Yeah, I think I would say they're responsible plays, right? So we're in an uncertain environment. We're strong. We have strong franchises, a strong capital position. And what we're setting out today is where we will leverage those strengths in our core markets. We're setting out cost reduction plans that we've indicated and discussed earlier. And we're also giving clarity on dividends and how we'll think about buybacks in the future. We need to recognize that it's still uncertain. Times are still tough. But what we're doing, I think, is being confident and ambitious in setting out our plans for the next 4 years, despite that uncertainty, so investors, staff, and our clients know what to expect as that uncertainty diminishes over time.
Clifford, this might be one of your last interviews as the CFO of ABN Amro. You have announced that you're going to be moving to Virgin Money. What advice do you have to your successor at the bank?
Well, I've been intimately involved in our new strategy, which I've discussed earlier. My advice to my successor will be to really continue the strategy that's laid out, that our CEO and our team will set out later today to investors and analysts. You know, I'm confident in the future of the bank. This is a strong bank, not only with strong capital liquidity, but also great franchises, a good client franchise, and loyal staff, and I'm confident in the success of the bank going forward.